Okay, so now we're dealing with a non-resident supplier of electronic services. So this person is a foreign person, is a foreign national. This person is basically making a supply of such a service, which could be, in this instance, as we've just touched on in our intro, in the form of making available online books. Someone in South Africa purchases a book online, let's say for about 5,000 rand. But this person is sitting in Ireland, so I would imagine Ireland uses pounds. So in this instance, let's just call pounds, let's say it's around about 750 pounds, right? So now, what SARS is now saying to this person is that, first of all, this person must be a registered VAT vendor, irrespective of the amount of turnover he makes. We don't care whether he makes 1 million rands or less than 50,000 rands. We don't care about that. SARS doesn't care. As long as this guy is basically transacting with somebody who has a registered address in South Africa, he must be a registered VAT vendor. So this person is basically expected to go through the process of admin, which would require him to fill out the 101 registration form. You know, I would imagine they would have to send it through via SARS platforms, and they would get a form certificate of registration, and they would have to start charging VAT based on the transactions that they would be making to South African people that would likely be located in South Africa. So once that's the prevalent case, and now we've basically taken this example of 750 pounds being the online book, and as a result of that online book now, the invoice that this foreign vendor now needs to provide, it needs to be in harmony with like a valid VAT invoice. It must be a valid VAT invoice in terms of the validity of invoices as per VAT standards of South Africa. We'll talk about this in our next week's lecture in terms of the valid invoices that you have to basically look out for. And within the VAT invoice, they must stipulate the amount of money in terms of how much output VAT they'd be charging in South African rands. So from pounds to South African rands. You know, so if the pound amount in terms of the output VAT is, let's say for argument's sake, it's around about, let's say it's around about 88 pounds, right? And they'll have to now convert it, let's say the pound to the rand at the current exchange rate would be 20. So in that instance, we'd say 20 times 88. That would mean you've got output VAT of 1,760 in terms of that being the output VAT that would be payable over to SARS as per the VAT 201 submission form. Right. So this would have to be clearly stipulated. You can imagine the implications that these guys are finding themselves in, because he still has to comply with Irish tax legislation, you know. Over and above that, he has South African tax to worry about, you know. So this is quite a handful for this poor foreign vendor, you know. But SARS doesn't care. They need to comply within these restrictions, you know. So if he's not able to come up with a valid VAT invoice, you know, it states to say that this person is now not being compliant in terms of the South African tax legislature, and he'd likely find himself in a bit of trouble. So these guys have to really be making sure that they're making provisions of submissions of valid VAT invoices that are in compliance with the South African tax standard, you know. So if you look at your Take a Lot invoices or your Amazon invoices, Alibaba invoices, they should rightly have output VAT stated and stipulated as to how much the output VAT payable over to SARS is, because these people are now tax vendors. That makes them VAT vendors in South Africa, irrespective of the tax legislature that they are emanating from. It doesn't really matter, you know. So and they also have to register as well, irrespective of the turnover that they make. As long as they're transacting with people situated within the Republic, they have to be registered VAT vendors and be paying over VAT to SARS, you know. So of course you can now claim back the input VAT that you'd be paying over to them, because you're a registered VAT vendor within South Africa yourself. So if it's a valid VAT invoice in this instance, you can, you know, claim back your input VAT without too much of a worry, so long as you are dealing with a valid VAT invoice from these people. So these guys don't have too much, which is really giving them, you know, the benefit, you know, because they're being charged in a situation which is rather not the ordinary process of charging VAT. But be it as it may, that's where these guys find themselves in. And the only relief that these guys have is that they can basically make use of their payment basis if they so wish. So they can account for output VAT once payment has been made. This is the option that they have in terms of somewhat of a relief, if you can call it that, because at least then they would not be out of pocket and they can make payment over for VAT once the actual payment or invoice has rather been made. So that's the option that they have. So yeah, that's the position that non-foreign, non-resident supplier of electronic services vendors find themselves in. Right, so another different situation that gives rise to VAT as well is now your non-executive directors. So not only are these guys expected to be registered VAT vendors, but they are also expected to aggregate their whole income, all of their income, all of it, be it service fees, consultation fees, accounting fees, and the director fees. They all have to be aggregated, you know. So there's one relief that SARS give these people, that states to say that as that is normally forward-looking, but in their instance they don't have to register for VAT until they hit their 1 million turnover. The likeliness of them reaching the 1 million turnover threshold is quite big, because obviously now all of their income is aggregated. And you can also imagine these guys now have huge output VAT liabilities, because they would likely make in excess of 1 million rands given their aggregated income. These are professionals after all. And as to whether they attend meetings and so forth, when you aggregate that income, they likely make more than 1 million rands in a particular year. And they likely have huge output VAT liabilities. And their input costs, they're almost up to zero, I mean, input costs for these guys, almost up to zero. Almost nothing, I mean, how much do they incur in terms of their costs, besides really just their time, They don't really incur much, so they don't have much to claim in terms of, that input. They don't really have much. Almost zero, Whereas for the companies that are charging, because these guys would have likely inflated their fees by 15%. To make up for the loss, but still, they'll still not be able to claim it back. Whereas companies, on this one hand, they don't really lose anything because they'll be able to claim back input VAT based on the service fees that the directors would have granted to them. So there's no great admin change for the companies because they're pretty much in the same company. The directors would have inflated their fees by 15%, but the companies, on the one hand, they would have been able to claim back the inflated 15% service income, which is now a cost to the company by the actual 15% input VAT that the company can claim back. So this is quite a tough one for the poor directors, and those are some of the situations that we may find ourselves in so far as the different VAT situations that just may arise.